Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Gavin McMaster from OptionsTradingIQ from Australia, from the Melbourne area. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just a reminder, this is for educational purposes only. So with that out of the way, Gavin, I want to welcome you. I think this is the first time you've been with us on the roundtable, and it's always a pleasure to have people come on and tell us a little bit about them and what they do. So welcome.
Yeah, thanks a lot, Tom. Thanks for having me. It's great to be here. Yeah, first time. So yeah, really appreciate the opportunity to present.
Oh, glad to have you here.
All right.
So yeah, if you can share your screen, then we'd be okay then.
Okay, hang on a second. Came up earlier with a little button to share. Now I've lost it. Sorry.
Could be on the quick start menu or on the share menu up at the top.
There we are.
I see something loading. There we go.
All right, there we go. Sorry about that. We're good to go now. Okay, so yeah, thanks again for having me on. What I want to talk to you about today is a couple of the strategies that I trade and some past results. So I'm going to be looking at weekly diagonal trades and bearish butterflies. Before I get started, just a little bit about me. So that's me there. That photo's a little old now. I've got 2 kids now and a little bit less hair, but that's me. I started trading options in 2004. I've spent thousands of hours researching, live, breathe, eat and sleep the financial markets. So as Tom said, I'm based in Melbourne. So the markets here are open for me from 11:30 p.m. till 6 in the morning. So that makes, or 7 in the morning. So that makes things pretty interesting. It flicks around with daylight savings, but yeah, a bit of a night owl. And as I was saying to Tom earlier, I've got a bit of insomnia, and probably doesn't help that I'm up on my phone half the night checking the markets. So I absolutely love this stuff, and I wouldn't have it any other way.
Gavin, did one thing have to do with another?
Yeah.
Meaning losing hair in trading?
Maybe, or maybe it's just a lack of sleep, or the 2 kids. That could be it as well. So I've authored 5 books. So I have a bullshit-free series. So I kind of try to tell things as they are. As you guys probably know, there's a lot of hype out there with regards to options trading, and Tom and Jim are obviously great guys and trustworthy guys who kind of tell it like it is as well. And that's kind of my motto, is to keep the hype and the bullshit out of what I talk about, and try to be realistic with people. So quick outline for the session. So going to talk about the weekly diagonal spread trading plan. So this is how I trade this strategy, and I've got 4 or 5 examples to go through. And then the same with the bearish butterfly. I'll go through the trading plan. Some of you are probably pretty familiar with the bearish butterfly. So that should be review for some of you guys, I would imagine. And then I'll go through some examples and talk about some different scenarios that happened and how the trades worked out. So here's a quick guide to the trading plan. So it's a short-term trade, usually about between 3 to 10 days to expiry. I'll be entering, looking for a small gain of sort of 1 to 3%, and sort of have a stop loss on that level as well. Try and enter this trade for a small credit if possible. Otherwise, a small debit is okay. And for this one, I trade Russell, SPX, Google, Amazon, and TLT. I've traded a little bit. Mostly I'm trading Russell, but certainly had some good trades in Amazon and TLT lately. I kind of look for when the market gets to an extreme. So I've got here the trading style I use a daily and a 30-minute chart. So I like to try to tie them together. So if the market's really, really overbought on a daily time frame and a 30-minute time frame, that's when I'd get into a diagonal call spread. And on the downside, if it was oversold, I'd get into a put spread. So the worst case scenario for the trade is a rapid move in the direction of the short strike shortly after entering the trade. So that's pretty standard with a lot of these types of trades. And the best case scenario is the stock moves away from the short strike within a few hours, and we can take profits early sometimes. Otherwise, if the stock slowly drifts in the direction of the short strike and lands in the profit zone on the third day of expiry. I'll go through that in some examples. In terms of entry guidelines, I look for short strikes around delta 10 to 15, and I put the strikes 20 points apart for the calls and as high as 40 points for the puts. So that's with the Russell. With some of the other instruments, you'll have to, or I'll adjust the differences in the strikes slightly depending on how high the stock or the index is trading. Try to enter for a credit where possible, and as I said, enter when the stock market's overbought or oversold on a 30-minute time frame and match that in with the daily time frame. If I'm entering for a debit, try to keep the risk on the defined side to less than $400. And in terms of exits, if the price gets within 5 points of the short strike, I get out no matter what. So I don't want the stock going through that short strike. Set a stop loss of around 2%. Short-term profit target of 1% within a few hours. If I can get out with a couple $100 in gains, I'll do that. And long-term profit target 2 to 3%. And I close on Thursday afternoon at the latest. I never take it into settlement on Friday. So some quick examples. So this was from 2014. Entered the trade on Feb 20th. So the market was overbought at the time. So I went in to do a call spread. You can see Russell was trading at 1160, and I went to the Feb 27th. So it was a 7-day trade. Sold the 1190 calls, went out 2 weeks, and bought the 1210s. So that cost 70 cents. And then on Feb 26th, I was able to close that out for 185. So you can see the beginning Greeks there. We've got delta of -7, Vega 74, Theta 74. So Vega Theta is 1-to-1. So that's really good. And delta to Theta is about 10%. So again, that's pretty good for an initial trade setup. This is what the graph looks like. So you can see on the downside, the risk is limited to the amount that the trade cost. Then on the upside, you can't see it. This is a zoomed in version, but with the spread being 20 points apart, trading 4 contracts, the total risk on the upside would be about $8,000. So what we're looking for here is for the market to, over the course of the week, just slowly drift up to about this 1180 area. But we don't want it going any higher than about 1185, and certainly not 1190, because that's when the losses are going to start to come in. And if the market shoots up really quickly up to 1185, 1190, then that's going to be bad for the trade. And on the same time, if the market falls really quickly, if it goes down to 1150 within an hour or two, sometimes you can get out for a quick profit. So this is where I entered the trade. So you could see we'd been overbought a fair bit. We'd had a small pullback, and then we're straight back up into an overbought reading. And the times I like to have this trade is where I think momentum will carry the market a little bit higher, but not too much higher. The market actually rose a bit more than I wanted it to here. But you can see the entry there on the green arrow, gone up a little bit, kind of flat the next day, then a big up move the next day. So the trade was sitting in a bit of a loss at this point. Then we kind of pulled back a little bit. The trade was looking okay here, back to sort of even, maybe a little bit of profit. And then on the next day, which was the day before expiry, or maybe 2 days before expiry, we've shot back up again, and we've hit sort of 1185, which was my signal to get out. So I waited till we got a small pullback and got out of the trade. And if you see, 30 minutes later, we got a pretty decent sized pullback. If I had have held on for another 30 minutes, profit on the trade would have been a lot better. I was pretty happy with the profit and was able to get out before it, breached 1190 or anything like that. So really want to get out of the trade before it gets too close to that short strike. So the next example, about a week later, this is an example where the stock pulls back really quickly, and I was able to get out. So I got in at sort of 10 a.m. and was out by 3 p.m. So it's almost like scalping a little bit, I guess. So similar trade, we're trading at 11.90. I've gone out to the 12.10s and sold those, bought the 12.30. So I always keep them 2 weeks apart as well. You can see this trade was a little bit more aggressive. I was a bit more bearish at the time, so you can see that delta is a lot higher at negative 31. The Vega theta ratio is still really good. The theta is a lot higher because I'm placing the spread a little bit closer to the market. So our delta theta ratio is a little bit more aggressive at 20% to start the trade. Similar sort of profit graph. So this is kind of what I'm looking for. Thinking that the market might push a little bit higher with the momentum, but not go too much higher. So this is the trade. So this was the entry point on the green, and then pretty quickly after we get a big sell-off, and I was able to get out of the trade here for a small profit. So you can see that even if the market goes the other way, if it happens pretty quickly, you've got positive Vega, so that helped the trade as well, and I was able to get out. If the market had have continued lower, I would have lost the 200, 250 on the trade, and you can see the market bounced back pretty quickly the next day, so it was probably a good thing that I got out when I did. So that trade worked pretty well. Again, just on the chart, just some divergence there a little bit. Market sort of trading flat, but the indicator selling off a little bit, so that was my kind of signal that the market might be about to drop. Okay, so third example, this is a much shorter term trade, this time on the put side. So after we had that big sell-off was kind of overdone. March 3rd, got in at 12 o'clock and was out just over an hour later. So Russell was at 1165, sold the 1140s, went out 2 weeks and bought the 1100s. So with the puts, because of the skew, you usually have to put a little bit more distance in between the strikes. This trade actually cost a little more, so it was 125, so I ended up only trading 3 contracts. And if we look at the Greeks, delta's 22, theta's 338, so delta theta ratio is okay. I find with these shorter term trades, the theta can be a little bit deceptive. It's maybe a little bit overstated sometimes, but we've got that sort of 79 Vega. And you can see I got out pretty quickly an hour later, made a small profit on the trade, $100 or so. So that's profit graph, the opposite of what we looked at previously. So we're hoping that the market doesn't go down below about 1150. Or if it pulls back up, we want to get out around 1170, 1180. So that was what happened. Got in at the bottom. Actually, thinking about it, didn't tie in this entry on the daily and the 30-minute time frame because we wouldn't have been oversold on the daily, but pretty oversold on the 30-minute time frame. I felt like we were about to bounce, and just one of those times where you kind of pick the exact bottom. Doesn't happen very often. Shot back up and managed to get out of the trade. If I had have held on, we continued much higher, and I would have had the loss. That was an example of diagonal spreads using puts. Okay, so most looked at Russell so far. So this is an example using TLT. I think that date's wrong, but anyway, so we'd had a really strong run up in TLT recently. So where we were trading it, can't remember where we were trading at the time, but sold the 140 calls and went out to the 145 calls 2 weeks later. You can see here a negative price. So I actually bought the trade for a negative amount. So I actually received a credit for getting into the trade, which is what I'm sometimes looking for. And if we look at the profit graph on the next screen, you can see that means on the downside, I've got no risk. So if TLT drops, I'll have at least a sort of $100 gain, something like that. So 10 contracts times 8 cents, $80 gain. So that's the worst that can happen on the downside. Trading at around 135, sort of looking for it to drift up to about 137, 138 over the next week. So delta theta ratios here are a little bit deceptive. So you kind of have to, I tend to look at the delta dollar number instead. So that's my overall exposure. If you're not familiar with that number, it's just the delta times the price, so easy enough to calculate. We've got positive vega again and theta, positive theta as well. So that was the start of the trade, and 6 days later, TLT's basically stayed where it is, so still at 134. So we've had a bit of time decay kick in, closed it out for 6 cents. So the 8 cents we received, and then the 6 cents for selling it, roughly 140 bucks in profit. So another one, TLT, a couple of days later, still really, really overbought. So I've gone and sold the 141 calls and gone out to 146. Again, received a credit for placing the trade. So really similar profit graph, similar Greeks, and just looking for that slow drift higher, 1 to 2% higher over the next few days. And that one was closed out for profit as well. So that's the diagonal. Now I'm going to look at some bearish butterflies and the trading plan. So very similar to John Locke's trading plan. I think his entry is sort of a defined 56 days to expiry. Whereas what I tend to do is I try to enter when the market's looking overbought. So kind of similar to the diagonal call spread, where the market's had a good run up, and I think momentum might push it a little bit higher, allowing me to scale into the butterfly, and then we get that pullback. So I enter more on a technical basis rather than time to expiry. So still looking at that 50 to 60 days to expiry, but I'll sometimes enter a bearish butterfly with 30 or 40 days to expiry and start it up. Prefer not to have them too short term because I find the P&L tends to move around a lot on the shorter term trades. So that can be a little bit annoying, particularly for me with the markets being open at night time. I don't want that P&L fluctuating too much. So same on the NASDAQ, and profit targets and stop loss, that sort of thing. So you guys can get a copy of these slides as well if you want. I can provide that. Just let Tom know. So just looking at the graph here, I've got some green and red arrows here, and the green arrows represent what would be a good time, in my opinion, to enter a bearish butterfly. So you can see the first one, the market's had a really strong run up, strong momentum, but we're overbought. We've got potential to move a little bit higher and then pull back. So this would be a great time to start a bearish butterfly. We move a little bit higher, maybe scale in with the second butterfly, and then we pull back. So you get that time decay, you've scaled in, and that would be perfect. Same with the next green arrow. If we get in there, market just a little higher, then it pulls back, that's perfect, and so on with those other green arrows. Now, the worst time to enter a bearish butterfly is on the red arrows. So when the market's had a sell-off, if you get into a bearish butterfly and the market just shoots higher, I just find that is really painful for the trade. You scale in, and then the market just keeps going higher, and your losses can really pick up pretty quickly. So I don't have that time to expiry factor. I'm pretty flexible with my dates. What I'm looking for is kind of an overbought condition where I think the market's going to drift a little higher and then pull back. All right, so here's a couple of examples we're going to go through. So on the NASDAQ, had a nice run up here, overbought. We've been overbought for a little while. Enter on the green arrow, 7 or 8 trading days pass, we get a pullback, and I'm able to exit without having to scale into the trade. So entered the trade on NDX, want NDX to slowly pull back towards 33.25. If it rises up, we're going to have the second butterfly. So we're trading at 33.64 at the time. So the NASDAQ trading rules are 50 points below. So wanted to keep it nice sort of round numbers. So 33.25. Put in the first butterfly. You can see the Greeks are pretty standard there for the start of a trade. That's our initial profit graph. So looking for that little pullback, or if we go higher, we scale into the trade and then hope the market pulls back. So November 7th, we were able to get out 25.20. So if I just go back, what did we put it on? 21.25. So made about $400 on the trade. Pretty low profit, but at the time I was happy with that. I felt like, I think the down day we had was about 2%, and at the time the markets had been pretty overbought. I was worried that sell-off might have a bit of legs and we were going to continue much lower, and that can be bad for this trade sometimes if you go down through the bottom of the butterfly, and you get the volatility spike because you've got negative vega, so that can hurt the trade as well. So that was the exit. We'd pulled back right into the center of the butterfly, and I thought, you know what, I'll take the profit and then take the risk off the table, wait for the next opportunity. So that was that one. Again, there's the graph. Get the nice time decay, 7 or 8 days, and the pullback right to the center of our butterfly. Okay, so another fairly similar example on the Russell. So we've had a really nice move up, overbought on the daily time frame. We've got the potential for momentum to carry us a little higher, which happened, not quite enough for us to scale in. So we were trading at around 1170 when we entered. So we put our first butterfly at 1150. We got up to about 1180, 1185, so not quite enough to scale in, and then we pulled back. You can see, we've had about 10 to 12 trading days go by. We've pulled back right to 1150 again, right to the center of our butterfly, so that's perfect. And then this was the trade entry. So started off at 1170, price is 743 for entering the trade, and Greek's pretty standard sort of setup. And a few days later, able to close it out at 1050, so about a profit of $1,000. So that was pretty nice in terms of the capital at risk. So roughly 750, 3 contracts, 2,300 roughly, 2,200. We've made 900 profits, so not too bad. And that was our position at the end. So, the interesting thing with butterflies, even though we're right at the center of the butterfly, we've still got negative delta. So I could have held on to it for a few more days. The market sort of bounced around a bit for a few days. Could have maybe eked a little bit more profit out of this one if I had held on. But again, the market was selling off. I was worried that we were going to end up sort of down here. We are going to get a volatility spike, and my profit was going to disappear. So I thought, you know what, we're right in the middle of the butterfly. Let's close it out. So again, that was the entry and the exit there. Okay, so the next one is a bearish butterfly on a decline. So a lot of people ask, usually with the bearish butterfly, you're scaling as the market goes up. Can you do the same thing when the market goes down? And yes, I do that. So this is an example where the market drops and it hits 1140. So it hits the outer wing of the butterfly. And I add a second butterfly on the downside. So we were trading at 1200. Centered the butterfly at 1180, cost us about 635. So this was our entry. Again, markets had a pretty good run up, a little bit overbought, and we've pulled back pretty quickly down to 1150. So the good thing on the downside is you've got a fairly big margin for error before you have to adjust. So starting at 1200, the first adjustment point's 1140, which we hit on that first green arrow. So I've got 1 adjustment, 2 adjustments, 3 adjustments as the market's hammering lower. So it's almost the opposite, where the market's going lower, you're scaling in, and then you're waiting for that little pop, which we got, and then the exit there on the red arrow. So we dropped to around 1100. So I think on this one I've fully scaled into the 3 butterflies, and then we get the pop up. I think I had 1 more adjustment. I think I rolled the butterfly down as well, the top butterfly, which, as it turned out, would have been better off if I didn't, but thought it was better to be safe than sorry with that one. So that was our initial graph. And here we are, we've headed down, we've hit 1140. So I've added another butterfly at 1160, so that's cost us 980. So that was our Greeks before the adjustment, and that's our graph before the adjustment. So we're outside our profit zone. We've hit the outer wing, so something needed to be done. And then there we go, adding the second butterfly. That's how we looked, looking for that little pop-up higher back into that profit zone. Didn't get it. The market continued lower, so we go down, we get another 20 points. We hit 1120. So I go ahead and add a third butterfly at 1140. So Greeks there before adjustment, you can see we've got no theta because we're outside the zone. So before adjustment and then after adjustment, we've now got our 3 fully scaled in butterfly. So we've got the 3 points here at 1140, 1160 and 1180. And we're trading at 1120. So we really want that pop up. We just want a 20, 30 point pop higher, but we don't get it. Market continues lower. It goes down to 1100, so it's gone down another 20 points. So what I do here is I sell the 1180 butterfly, I roll it down to 1120. So roll it right down 60 points. As I said, if I had have left it as it was, profit would have been much, much higher. But you can see on the graph that we're well outside the profit zone. The Greeks weren't good at all, so I've pretty much just got direction at this point. There's no theta in the trade. Really just a directional bet at that point, so I wasn't happy with it. Kind of stuck to the rules with this one and rolled it down. So this was our graph beforehand, sitting right at that outer wing. And then once we roll the top butterfly down, 1120, you can see we're back right on the edge of our zone. And again, just looking for that 20 to 30 point pop higher, get us back into that zone, get that time decay and close it out. So managed to close it out, as I said here, profit of 710, which if I hadn't have rolled that top butterfly, would have been more like about, would have been 1500 or so maybe. But 24% return on capital, so that was sort of within the profit zone that I'm looking for, 20%. And you can see we bounced back up to 1130, so we're back into the zone and ended up being able to close it out. Could have held on, let's check the expiry actually, so it was May 15th trade. We've actually still got a month to go, and if we look at the trade, we did kind of bounce around for the next month or so could have stayed in the trade longer and had even higher profits. But sometimes when I'm fully scaled into these trades, and as you're getting a bit closer towards expiry, the P&L does move around a lot. So I closed it out, but would have done much, much better if I had have held on to it for another week or 10 days or so. Okay, next example, again, market's going higher. This is a really nice trade. This is sort of the perfect trade that I like to be in. Works really well. So we're overbought. We've had a really nice run up. We've gone from about 1080 to 1180. So a 100-point move over the course of a month. Really strong momentum. Maybe we're going to push higher. And that's what happens. We scale in, and then we get that nice pullback. So we're at we're trading at 1180. So first butterfly at 1160. You can see the initial butterfly usually costs about $7 or so. Again, pretty standard starting point. And then Russell breaks above 1200. So we add our next butterfly at 1180, costs us 767. So that's our Greeks before the adjustment. Delta of -17, theta of 7. So not looking too good there. Again, we're well outside that wing. And then that brings us back to a little bit better looking. Again, our Greeks still aren't great because we're outside the zone. Delta is much higher than our theta. But we do get the pullback to 1168. So we're right in between the two butterflies. Close them out for $9 and 10.45. So profit of around 9.25. that was exactly what we're looking for. We kind of pull back right to the middle of the zone and close out the trade. All right, so looking at a, that was the graph on that trade. So next, losing trade example. So this was a bad one for me. So I've only shared winning trades so far. So painful as it is sometimes with these losing trades, it's always good to look at these. I think people learn more from the losing trades than they do from the winning trades. So I'll show you probably one of the worst trades I had on a bearish butterfly. It was an interesting one. It was one of those ones where if I had stuck with the trade a few more days, it would have worked out really, really well. But I kind of reached my pain point and had to close it out. So this is what can go wrong with a bearish butterfly. So starting off, we're at around 1120. So you start the butterfly at 1100. And that was the entry point. So you can probably see here what I've done wrong in terms of what I look for. Market's not really overbought at all. In fact, we've had a pretty solid downtrend for a month or so, almost 2 months. So really terrible entry point for a bearish butterfly. A better entry point, this is the one we looked at previously where the market had the strong run up. So, mid-June would have been a much better entry point rather than mid-May. So first entry, scaled in, adjusted, market continues higher and got out right at the top. So just one of those ones where, sometimes that happens on a trade. If I had held on, would have been totally fine. But as it was, took a loss on this one. So initial graph there. So first adjustment, we've hit 1140. So I've added one at 1120. So again, pretty standard stuff. That's our graph after adjustment. And the next one, we've hit 1160. So I ended up doing a little bit of a different adjustment here. So again, just didn't stick to my rules really. Rolled the bottom butterfly up by 40 points. So sold the 1100 butterfly, bought the 1140, bought the 1160. So that got me a profit graph fully scaled in, looked like this. So, not too bad at this point, but again, just my entry point was all wrong. And the market just continued higher once I'm fully scaled in, which is not what you want to have happen. So I ended up adding a fourth butterfly. So you can see, I've gone way away from my trading rules here, which was just not good. Pretty horrendous trade really. Before adjustment, that delta is getting up pretty high, higher than theta. Afterwards, we're getting back to sort of 1-to-1. Interesting looking graph now that we've got 4 butterflies. So it's not a bad looking structure. It's just that my entry was really bad. And if you can see the purple line there, that's about a week from that day. If we get that 2 to 3% pullback, I'm looking really good. But unfortunately, we just continued higher at 1177 here, and then we break up above 1200. So ended up taking a loss of $4,000 on this one, which was just a shocking trade. Painful to revisit, but I think it's good to look at these ones and see what can go wrong. So closed it all out. 3 days later, the market finally reverses. If I had have held on, would have had a profit of $6,000. So by the same token, if the market had have continued higher, those losses could have been even higher. So we'd just broken through sort of that psychological level of 1200, and I thought maybe the market was just going to go from strength to strength. So yeah, bit of a painful trade, but certainly a good one to look back on and just remind myself what not to do. So we got there. If the market had continued up, could have lost another $5,000 or $6,000. So as you're getting close to expiry, we're right at expiry here. So the P&L just fluctuates a lot. So I think the day before we got that big up move, I was only on a loss of about $1,000, and then all of a sudden we break higher by 20 or 30 points, I think it was. So we're at about 1180. If we look at the next screen, Yeah, we're at about 1180. We get this massive shot higher. Maybe might have been a Fed day or something like that, or trying to remember now. They might have come out with another QE announcement or something in the morning. The market shoots 2 or 3% higher, and that just absolutely killed the trade. So that's what can go wrong with a bearish butterfly. And again, if I had have had a better entry point and stuck to the rules a little bit, not gone in with a fourth butterfly, which was a bit silly, the trade would have been okay. But just that entry point was really the main thing that went wrong. So that was it. That's everything I had that I wanted to share today. So hopefully you found that helpful. I blog over at OptionsTradingIQ, so feel free to jump over there and read some of the other stuff that I put together. A lot of free stuff on the site. Trade a lot of iron condors, butterflies. So I've got an iron condor course that you can go through for free if you're interested in that. Same with the butterfly course. And also just finished a book on covered calls. So recent articles on the blog. I've got about 13 or 14 detailed articles on covered calls. So if you're interested in that, you can check that out. But just, I want to thank Tom and Jim again for the opportunity to come and present today, and wish you guys all the best of luck with your trading.
Oh, you're welcome, Gavin. Thanks for coming. I remember I had an 8th grade teacher who always said the questions on a test you remember are the ones that you got wrong, and those losing trades really stick in your mind, don't they?
Yeah, absolutely. So, yeah, that was a painful one, that one. But yeah, it's always good to share these things. I find when I speak to other traders and I do a bit of coaching, and always find that the losing trades are the ones that they get the most out of. So it's always good to see what can go wrong and what not to do, basically.
So Gavin, what would you say your bread and butter trades are that you do the most?
Probably bearish butterfly. I have an adjustment on the condor that I do a little bit of. It's kind of like the weird ore that I think maybe it was one of your guys who came up with, or one of the Sheridan, Amy Messner, I think, came up with it, did she?
Oh, Meissner.
Meissner, yeah. So I trade that a little bit. And trade a lot of those diagonals, those weekly diagonals. So look for an index or a market that's got to an extreme point. Trade them mostly on the call side. I find they're a bit more tricky on the put side, just because the market can really drop a lot quicker, which is not what you want. Whereas on the call side, the market kind of tends to take the stairs up and things move a little slower, which can benefit those trades. So used to trade a lot of iron condors, but I'm kind of moving away from that these days. I don't know if maybe it's just the low volatility environment that we're in at the moment, but I've just been finding that, just the risk reward on condors sometimes isn't that great. Whereas I really like the diagonals and the bearish butterflies, and I trade some strangles as well. So just wrote an article on my blog about how I use Bollinger Bands and the Bollinger Band width. So when the Bollinger Bands get really, really close together, that's a good indicator that we're going to potentially have a breakout. And I'm not great at picking directions of stocks and markets. I think it's quite hard to do consistently, but I like to look for that time where, we've had a really tight consolidation for a few weeks or a month. And then after that period of consolidation, you usually do get a breakout. And if you trade a long strangle or a long straddle, doesn't matter which way the market goes, you just want it to move really quickly and really far. So I'll trade that. And then on the other side, when the Bollinger Bands are really, really wide, volatility is really high, stock's been moving around a lot, I like to put on a short strangle and take the theory that, after a period of wild movement, things are going to settle down. So those are kind of my main bread and butter trades.
Yeah, we have, I guess, Adam Grimes calls a volatility compression or low vol in the VIX right now. So this is probably the time you're looking for the long strangle type of trade, I'm guessing.
Yeah, exactly. So, we've been trading in a really tight range for quite a while now. So I actually just entered a long strangle a couple of days ago. So hopefully we get a bit of a volatility increase. We did get a little sell-off yesterday, but not quite as big as I was hoping for. But hopefully we get a move within the next couple of weeks. So I usually go out, if I'm doing a long strangle, I usually go out about 6 months. And if the move hasn't come within 2 months, I close it out. So I have a 30% profit target and sort of a 10 to 15% stop loss. So if neither of those get hit, but 2 months has passed, I want to get out of the trade anyway because I don't want to suffer too much time decay. That's kind of how I do it. And then if I'm trading the short strangles, I want to be a lot shorter time frame. So sort of 1 month.
Let's see, we had a couple of questions here. I don't know if you can see the chat. Martin asked, do you adjust the weekly diagonals or do you just close it when you hit your max loss or profit?
Yeah, so great question, actually. Don't adjust them at all. So I just find with weekly trades, they're really hard to adjust because you're so close to expiry. I just find there's not much you can really do if a trade goes against you. So I don't adjust it at all. I'm either, and that's what makes it quite easy to manage as well, is you put the trade on, it either works or it doesn't. So, I take my profit or I close it out for a loss, and that's it. It's nice and easy.
And Theo asks, a lot of people are talking about short strangles, including Tasty Trade, but he's nervous about the, doing naked shorts due to the unlimited risk. So, are you doing nakeds, or are you doing more like iron condors for your short strangles?
Yeah, no, I'll do both. So I'll do iron condors, but also do the naked short strangles. But I just want to keep position size pretty small because, yeah, as you said, they can be risky if you get a big move. But I just find often, if the market or a stock has had a big move and been moving around a lot, after periods of high volatility comes a period of low volatility. So if you're pretty selective with your entry points, you can usually ride it out. And I also don't trade individual stocks for strangles, particularly short strangles. I don't want that risk. There's earnings announcement or some bad news item comes out that you've just got absolutely no control over, and the stock gaps up 5 or down 5-10%. It's just going to kill you. So I tend to stick to the main indexes and main ETFs. Stay away from gold. I never trade gold. I don't know if you guys trade gold, but I just find that the volatility, the implied volatility in GLD is really low, and you don't really get compensated for the amount that the ETF moves around. I find the ETF moves around a lot, but volatility is still really low. It just doesn't make sense to me. So, stick to iron condors, strangles, bearish butterflies, and mostly just trade the major indexes, sector ETFs, country ETFs, TLT, things like that.
Yeah, I used to do some futures options on currencies like the euro, and got burned a bit on a 7 standard deviation move in 2008. So, it just takes a central bank announcement to have sometimes those things just take off. Like when Switzerland announced they were going to depeg. So yeah, the currencies can move really quick too. So I tend to avoid those these days as well.
Yeah, exactly. I've never really traded currencies other than just a bit of hedging with the Aussie dollar, because obviously a lot of my income trading profits are in USD. So I might do some little bit of hedging on the Aussie dollar sometimes, but that's about it. I find currency trading a really hard game. I don't know how people do it. So, and I remember that Swiss incident, a couple of brokerages even went bust over that. So what's a private trader? What hope's a private trader got if broker firms are going bust?
Let's see. Theo asked another question. Do you do iron butterflies and broken wing or unbalanced flies? And what's your take on those strategies as well as the unbalanced condors?
I don't do too many iron butterflies, assuming you mean at the money butterflies there. So I tend to just trade bearish butterflies. I'll do broken wing butterflies occasionally. I don't mind those. I tend to prefer the diagonal trade though. I just like the diagonals because you've got the positive vega, so that can help offset some of your other short vega trades.
And then Martin says if he understands it correctly, monthly butterflies are basically adjusted by scaling.
Yeah, exactly. So, as the market moves up, you're kind of scaling in. So you start with a 1/3 of your total position size, and then you scale in as it moves up. And then if it continues to move up, you can roll the bottom butterfly back up to the top. So.
And then Jose asked, do you still trade the trapdoor? And if so, how has it done lately?
Yeah, so the trapdoor is very similar to the weird ore, just a slight adjustment that I've done. I do still trade it, but I haven't traded it much recently. Again, just this low vol environment has just been really tough. And I've been doing more of the diagonals and the bearish butterflies lately. But I have had a lot of success with the trapdoor. I find that I almost prefer that trade to the condor these days. With trapdoors or weird ores, the market can have a pretty big move, and it handles that move a lot better than a condor does. So I had a class recently where we looked at a trapdoor and a condor, and the market made a big move. The condor's sitting in a bit of a loss. The Greeks are out of whack. It's in a little bit of trouble, whereas the trapdoor was perfectly fine, didn't need to be adjusted at all.
Yeah, Dan Harvey came up with the weird ore to address a lot of the condor problems, and it's a good trade, but like you said, in the low vol environments, it's tough.
Yeah, absolutely. So, hopefully we get some volatility soon, and we can see those option premiums just bump up a little bit.
Let's see, Martin says, do you skip a monthly butterfly trade when you don't get an overbought market within 50 to 60 days to expiration?
Yeah, absolutely. So, as you saw with those examples, if the market's not overbought, I don't want to get into a trade. So I'll happily skip a month and not have a butterfly trade on if I don't get the right conditions for sure.
I remember I did some training with Joe Ross years ago, and he always used to say cash is a position. So.
Yeah, exactly. And that's one thing I've learned over time is that just don't feel like you have to be in the market all the time. Like I used to feel like I always had to be doing something. I had to have a trade on every month, had to have a condor on every month. But it's actually so nice when you don't have positions on and you can just be patient. It's one of the hardest things to do. But I've found that's been the biggest improvement in my trading is just being really patient and just waiting for those perfect setups.
Well, and I got 100% cash the day before Brexit, and I was really glad I did. So sometimes if you have planned events like that, it can be you can rest easy if you're all cash.
Yeah, exactly. Especially for me, I can sleep better, so don't have to check my phone in the middle of the night.
There we go. Theo says he loved your volatility book. Do you have any more books planned?
So I've got a covered call book that I just released, so you can check that out. I've also got, assume you've seen the others, but a book on iron condors, a book on butterflies, and another book, a short book, 37 quick tips for trading options. So just 37 really short chapters just on some of my best advice, things I've learned over the years. So that's a good one as well. You might want to check out.
Where do people go to find out more about the books or how to get them? Are they on Amazon or on your website?
Yeah, they're just on Amazon. So if you go on there and just search for Gavin McMaster, you should see them there.
Okay, perfect.
Yep.
And then let's see, Theo asks, he's hearing more about the second order Greeks like Charm, Fama, etc. Do you do anything with these Greeks or not?
No, don't really do anything with those. I understand, how they can help, but I just find them noise. So I have my ways of managing trades and, looking at the Greek ratios and things like that. I find is fine.
Yeah, makes sense.
Yeah.
I think we've run out of questions. So Gavin, it's getting late here, and you're just starting your day. So thanks very much for joining us. I'll get this recording, and anything you want to mention on your website for people to take a look at?
And I mean, if you want to just go check it out, there's lots of free stuff there that people can look at. So yeah, feel free to visit the site, and every now and then I'll give away those books for free, so you can check those out. But yeah, just appreciate you having me on, Tom, and always love presenting some of this stuff, and hope to be back at some point.
Oh, absolutely. And if you have any articles on your site, do you mind if we cross-post them on our website and give you attribution?
Yeah, absolutely. That'd be fine.
Great. Oh, we did have another one. Theo says, do you trade earnings?
Personally, no. I don't like it. It's something a few people, I get asked that question all the time, and I know some people do it and do it successfully, but it's just not really my style. I don't like the potential that a stock is going to move 10, 20%. Like, it's just not my style at all.
Yeah. And then Chris asked, do you have these sessions every so often? I don't know if you're talking about our roundtable at Capital Discussions, which is every week, or Gavin, do you do weekly webinars or presentations, anything on a routine basis?
Every couple of times a year, I'll run a group course. So that'll be sort of a 1 month in duration course. We do 8 sessions, and we look at 6 different strategies. So we'll put those on in the market. We'll follow along with those. So if you sign up to my email list on the website, I'll shoot you an email when those sessions are. I'll probably do the next one maybe in September or maybe October. So sometime in the next sort of 6 or 7 weeks, I'll probably be looking at doing a new monthly group session. And we have a private Facebook group as well that people who have been through that course that they can join, and that's where people sort of discuss trades and trading ideas and stuff like that. So as I said, if you just sign up to my list on the website, I'll shoot you an email the next time that's ready to come out.
Great. And I guess Chris was asking about the roundtable, and yes, we do those every week, normally on Wednesdays at 11 a.m., but we had to change it today, so Gavin didn't get up at like 2 in the mornings for this. So
Yeah.
Appreciate everybody being flexible on the time this week. Theo, I did ask one more question. Do you think technical analysis is valuable? A lot of people, including Tasty Trade, feel it's a waste of time. What's your take on technical analysis?
Oh, I think it's very important. As you can see on those examples we went through, most of the entry points were based on technical analysis. So the diagonal trades, we're looking for that overbought reading. Same with the bearish butterfly. You could see the examples where that worked really well, and then the one example where I got in when the market wasn't overbought and it was a disaster. So yeah, absolutely. I think technical analysis is important.
Great. All right. I guess we're running out of time. We're nearly an hour, which is where I like to cut it off so we don't take up too much time. So thanks again, Gavin, for getting up a little bit earlier than normal if you weren't up already. And thanks, everyone, for sticking with us. Really appreciate it. And I'm sure we will have you on in the future, Gavin. So thanks again.
Yeah, sounds great. Thanks to you as well, Tom. Cheers.
All right. See you, everyone.